welcome to the seventh episode in the Calm Allocator series, where we have repetitively focused on getting to the crux of issues through our Expert Connect. As we approach the post-pandemic, or rather the post-vaccine economy, the policy prescription becomes a key to watch out for, both for the financial markets and economic recovery. We also have the budget coming out on the 1st February, which will reveal the fiscal temperament of the economy going forward. Joining us today is Dr. Sabyasachi Kar. Dr. Kar is RBI Chair Professor at the National Institute of Public Finance and Policy. He is an honorary senior research fellow at the University of Manchester in the United Kingdom and research partner of the ESRC GPID Research Network based at the King's College London. He's the co-editor of Journal of South Asian Development and associate editor of Indian Growth and Development Review in the UK. Professor Kar has provided input for successive 5-year plans in India to the Perspective Planning Division of the Indian Planning Commission and worked on projects sponsored by World Bank, the Global Development Network, the European Commission, and the DFID UK. He also has several renowned books and papers to his credit. Thank you for joining us today, Dr. Kar.
Thank you for inviting me.
So you have a very extensive experience in the policy space. And we stand at this crucial juncture where the fiscal and monetary layout in India has been very different from the West. While West has focused on direct fiscal support, cash transfers, etc., India has rather used this space for building long-term structural changes. And also in the monetary front, India, the monetary policy has done a lot of heavy lifting, but the approach has been very different from the West. So what do you make of the policy choices we've made in the pandemic year? And what, according to you, would be the ideal policy prescription?
Okay, so I think it's best to start by taking a step back and trying to see the context in which all these policies have come across. And it's very useful that you've started by talking about the global economic policy approaches, because although we know that our economy is significantly different from the Western countries, in many of our policy approaches, we try to pick up best practices from them. So, the policies do not take place in vacuum. They have a history, and it goes right back to the 1970s, 80s. And we need to understand how policy, both fiscal and monetary policy, has evolved in order to get a better understanding of what we need to do now. So it all started with very strong fiscal policy, which was part of the Keynesian economics toolkit, and that was what the West also believed in and did till about the 70s, etc. But after that, inflation hit the global economy in a big way, and monetarism came across, and so the focus shifted from fiscal policy to monetary policy. And in fact, fiscal policy was thought to be, there was ideas that fiscal policy was doing profligacy, so it needed to be controlled. And so over time, what has happened is what was known as fiscal dominance was brought down all over the world. And increasingly, what has happened is monetary policy and basically based on central bank independence, ideas of that sort has gained momentum. And this is where we stood before the global financial crisis. But the global financial crisis actually have changed a lot of things in the policy space. So what has happened is, after the crisis, the problem was not one of runaway inflation, but in fact too little growth. And the globe was, trying to all the countries in the West and developing countries were desperately trying to revive demand somehow. And increasingly, they tried all kinds of things with monetary policy, including both conventional and unconventional monetary policy. But increasingly, what has happened is they have found that monetary policy has its limits. They have come to almost zero or negative interest rates, which is, in a sense, the limits of where monetary policy can be effective. And now again, we have a situation where Internationally, there is a thinking that perhaps we need to go back to some extent of fiscal policy. It's not a return to fiscal dominance anymore, but more like a balance between fiscal and monetary policy. So that's why the international economic thinking is also going. Central banks are also getting reconciled to this kind of thinking, as are ministries, finance ministries all over the world. Now in India, we had a similar kind of run, from fiscal dominance, because we had in the 70s, as everybody knows, we had a very statist approach before reforms, and then we had a spate of monetarist reforms in the our monetary policy, which gave rise to things like both FRBM in the fiscal space and inflation targeting in the monetary space. But again, we have also run into a certain set of problems which monetary policy is not being able to tackle. And the specific problem that we are facing, and this obviously happened before COVID, is that we are having very reasonably good growth rates, but there is not job growth. There is no inclusive
Yeah.
growth. And as a result, the political economy of this type of growth is forcing the government to increase revenue expenditure, because basically these are the ways in which you can take care of people who are not getting jobs, who are basically at the receiving end of the kind of growth we have. So increasingly what has happened is, as you see, in the last few years, the government has been forced to imaginatively manage their fiscal deficits in a way so that they can take care of this pressure of revenue expenditure. So that is where we stand. And then we had COVID, which was a very different kind of shock. And of course, I think what we need to, think of going forward, you asked the question, what should be our approach? I think we need to have a different, we need to think in terms of the pandemic years and the post pandemic period. So I would say short run and medium run. And this is because we are still not sure whether we are over the danger mark as far as the pandemic is concerned, especially this year. No, we are seeing what is happening in the UK and in other countries where second, third waves are coming back. So as far as the focus of this budget is concerned, uh, it needs to be a balanced budget, a balance between managing the pandemic as well as kickstarting growth back. And so it is, and this is why it is going to be so difficult. The perfect balancing has to be maintained, and that might mean for 1 or 2 years not really focusing so much on our deficit targets that much, because in fact what we will need this year is both larger revenue deficits as well as larger fiscal deficits, because we'll need to make revenue expenditures in case the pandemic continues. And we are increasingly seeing data of a section of the population that is being, the people are talking about the K-shaped recovery. So some amount of funding has to be for that part of the economy. But at the same time, if we do not kickstart our growth process, and I'll come back to this later, for which I think we need public investment kind of expenditure on infrastructure, etc., then we'll not be able to manage this for too long. So that is what my approach would be to fiscal policy in this year.
Very interesting insights there, Dr. Kar. And we at the corporate end of economics have also been seeing certain trends like this. So let me pick you up on this thing where, monetary policy has its backstop at inflation and fiscal is supposed to abide by the FRBM. Now, in the pandemic world that we are in, how much would you throw more light on what FRBM allows you to do? And secondly, we would want a looser monetary policy. Also, I mean, India's real rates have fallen. They're still higher than our peers. And there's little been done to actually revive consumption that we've seen transmit into the economy. So even though monetary policy has done its bit, it's probably not penetrated that well yet. And again, there's a K-shaped recovery that the talks of which are very common. So in that context,
Right.
fiscal becomes very important to reduce the inequality in a certain sense. So two questions. So how much can you go beyond FRBM, and what do you make of the inflation hawks on the monetary front?
Right. So let me start with the inflation side first. So it's a peculiar situation globally, and if you look at India, globally, in fact, right after the global financial collapse, the recession, demand has collapsed, and it has not really made a comeback. So you have, in fact, very low inflation rates in those countries. That usually the targets in these countries are about 2%, but they're not even managing to go back to 2%. Their inflation rates are low and their growth rates are low. And as a result, and this is why, and as I was trying to explain to you earlier, there is much less concern with inflation globally and much more about growth. Now in India, it's slightly different. We have had growth not collapse, growth come down for a different set of reasons. I'll go into that later. But as far as inflation is concerned, what has happened is, and this is not only for India, it is true for many other developing countries. Most of our inflation is not because of excessive demand. In fact, most of what has happened is with the adoption of the inflation targeting framework, I think we have been able to control demand quite well. And so, and despite that, you find that inflation rates in the last few quarters going above the comfort level of the inflation rates, and that's because we have a lot of supply side shocks and supply led inflation problems coming mostly from the food sector, but in the past it has also sometimes come from petroleum sector. Basically international price rises in petroleum getting to those shocks leading to inflation in the economy. So the thing to understand is, and on top of that, you have in post COVID, you also have another kind of inflation that is basically happening because of the disruptions that are taking place. I read a lot that services sector, for example, prices are going up, and that's because of social distancing and other kinds of lockdown requirements. The basic cost of services are going up. So you have cost push inflation coming from the COVID situation as well. Now, I think there are two parts to managing this inflation. One part is to take care of the disruption. Try to solve the problem of the disruption, which by itself will bring down part of the problem. But there is the other aspect, which is that inflation is also dependent on inflationary expectations. So if there are already some amount of inflation, that will play into the expectations. And I'm at some point the monetary policy committee that sets our policy rate will have to also take into account this aspect. But I don't think right now we are there at all. Right now, I think a lot of this inflation, and in fact, in the last quarter or last months, I think there is a downward trend in inflation as well. So basically, it is it has to focus on government intervention that can solve these basically the kind of destabilization that has happened. For example, if in onion inflation is a very frequent phenomenon in India, as most of us know. But the solution to this usually happens by import of onions rather than by cutting down on policy rates, etc. So on the inflation front, I think we need to be careful because I don't think we are in the in India. What COVID has done is it has destroyed not only the demand but also supply, because we have a lot of informal sector where capacity has been destroyed by COVID. So when both demand and supply has been destroyed, till we reach the original point, we are not sure which one is the binding constraint, whether it's going to be lower demand or maybe it will be a mix. Some sectors it will be supply constraint, and in others it might be demand constraint. So there's always a chance of inflation making a comeback. So I think the monetary policy needs to be very careful with this. But I don't think we need to be overreactive on inflation front. And coming back to your original question, I think that is where it provides us with space on the fiscal front to work on the problems of poverty or inequality that, or I would like to think of these as social safety nets that we need to provide to people when these kinds of shocks happen. One point I want to make here is that, in fact, while monetary policy is very effective in many ways, it is a blunt instrument. There is one rate that you are talking about, or maybe two rates if you are also talking about things like LTROs, TLTROs. But for much more refined problems where multi-pronged approaches are necessary, fiscal policy is much more useful because you can do many different things using fiscal policy. So I think we'll have to accept, I won't call it fiscal dominance, but maybe we can call it fiscal monetary coordination in a way where the immediate problem of COVID can be taken care of. At the same time, we take care of the infrastructure creation, bringing growth back, etc.
Dr. Kar, as you were saying in your earlier narrative also, this budget is on a balance beam. It's all about what the economy needs and how much could we extend on the fiscal deficit front, ratings, FRBM, everything comes into place. Now, last year, we had a budget of about 30 lakh crores. And on that, there is a huge expenditure, about 20 lakh crores as per numbers we've been watching, which is just interest payments, salaries, wages, Narega allocation,
Right.
PM Kisan. And these numbers will go on year after year. So even these are more like a
Right.
committed expenditure of the government. So we will again have them coming this year. Now, given the problem of, low employment in the economy, low job creation in the economy, we probably need more of capital expenditure. And also private capex has taken a very sharp dip. So
Right.
what could the government do to, balance it out ideally without, budging on the fiscal deficit target a lot? And secondly, you could also help us with understanding how much this FRBM allows you to go overboard in a year like this.
I think that's a very important point. And let me give you a little background why this is so important. Uh, in the past, if you go back and look at data, there were periods where our capital expenditure, government's capital expenditure as a proportion of GDP, were as high as almost 5%, 4%. And then when we adopted FRBM also, the underlying idea was that at least the central government expenditure on capital will be at least 3% of GDP, because we had a revenue deficit of 0% and a fiscal deficit of 3%, which means that basically the extra capital expenditure over and above revenue expenditure is going to be 3 minus zeros, basically 3% of the economy GDP. But if you look at the data, pre-COVID, just 2019-20, it has now come down to 1.7% or 1.8%. And what this is doing is basically it is dragging down our productive capacity, our long-run growth rate. If you look at the growth rate, the way it has been falling from about 7% 3-4 years back to 4% just pre-COVID, this is not this fall is not a complete fall in demand only. You can't have such a drastic fall in demand. What has happened is that our productive capacity has also come down, or the growth rate of productive capacity has come down. As you pointed out, that's majorly because private investment has been falling over this period. So capacity is not being created as much as we need to. And on top of that, in the last year, there was a demand problem as well. But just solving the demand problem will not take us back to the 7% growth rate. We need to create capacity. And what is being increasingly understood is that this is not something that the private sector can do on its own, because there is a complementarity between certain expenditures between the private and the government, which are very critical for growth. What the obvious example is infrastructure, roads, and a number of other things, ports, and we know in India we don't have enough of these. So unless capital expenditure goes up, what we won't have are more greenfield kind of projects taking off. The government, meanwhile, what we have been trying in the last few years we have been trying two things. Um One, we tried the first thing we tried is the PPP model, where the private and public partnership comes together to create infrastructure. But as we have seen that this has actually led to disastrous consequences in the financial sector. Some of our biggest NPAs in the banking sector are infrastructure projects, energy projects, etc. And that's because there is an obvious mismatch in the time horizons of the basically what is called the asset liability mismatch in the banking sector. The infrastructure time horizons are much larger, so that's not working very well. The other thing that the government has been trying is to try and access the long term savings funds, things like pensions and insurance funds, etc., international funds. But even there are a lot of reforms that are needed before we can actually see some of these funds taking an active interest in infrastructure creation. And my understanding is that even there, they are more interested in the brownfield projects, not so much the greenfield project. They are interested in taking over a project when it has been created and managing that project. So I think the government basically has to balance it. Again, it's a balancing act. It has to try all of these things. So first of all, it needs to the government has to understand that greenfield projects will most probably come from government expenditure itself, and so willy nilly we'll have to find funds for capital expenditure from the budget. Uh, at the same time, we can transfer already projects that have reached a certain kind of maturity will be brownfield projects to these long-term private sector funds, so that fresh money can then be used again to go back and create greenfield projects. So that has to be the overall approach. And of course, we have been hearing for a long time, talk of privatization that will also have to be carried out, and funds has to be used for greenfield projects. So it has to be a mix of all of this, some amount of privatization, some amount of. I would hope that the finance minister has raised our hopes by saying it will be a path-breaking budget. So I would hope at least we can go back to 3% GDP, which was the original FRBM target. If we can go back to that, it will be great. And then also bring in these other long-term funds for the brownfield projects.
Okay. I'm sorry to interrupt you, Dheeraj. Just a quick question. Are we saying 3% GDP growth, or are we saying getting back to fiscal deficit targets?
Yeah, I'm saying 3% of GDP needs to be put into public
CapEx.
expenditure. Yeah, capex. So now we have close to 1.82%. So 1%
Yeah.
extra GDP needs to be brought back into capital expenditure. That's what I'm
Right.
saying.
Yeah. Okay. Fair. So about 2 trillion more that goes into the capital expenditure front is
Right.
what we are
Right.
looking at.
But
Fair.
yes, remember that one thing about public expenditure or capital expenditure is that, I mean, you can't do it 1 year and go back to again 1.78% next year, because these are long-term projects. So it has to be done on a sustained manner. So that is something. So for that, you need some kind of long-term planning for this budgeting as well.
Sure. So basically, I think the Indian outlook should change from managing finances every year to a more medium to a longer term outlook
Right.
on the budget that would, I think, help the economy, something that we've been wanting for a while now. Speaking
Right.
of growth, we have, I mean, there are many pillars of growth rather that have been missing from the economy, even pre-COVID, but quite specifically, we've done bad on the exports front. We have been at, I think, $300 billion of exports since 2013, up for the 7 years straight now. So there has been no growth on the exports front. And we recently had this production-linked incentive schemes. We are trying to change something on the manufacturing front. So what do you make of the domestic manufacturing picture and what it means for India's exports overall?
It's a great question that you've asked, because I think our exports can't be understood or discussed unless we discuss it in the context of our domestic manufacturing sector. And just to give you a bit of context, what has happened is that I would say there are two important things that have happened. One is, of course, our exports are very closely related to global growth rates and global imports. And that itself has been following for some time. Global growth rates have been following, as well as there is an extent of protectionism that has come into play in international trade. So that's one of the major reasons over which we don't have too much control. That's something that we can't do much about. And as far as if you look at the closer at the export data, it is you'll find that high skilled exports or services or products have not done that badly. Things like pharmaceuticals or in the services sector. What has really taken beating is low skilled exports like basically garments or even some amount of machinery, and that's happening because of a number of reasons, including some of our own neighbors getting better at these sectors. Bangladesh has become the number one export sector in garments, and Vietnam has taken over the machinery sector. We have certain disadvantages vis-a-vis these countries, which we can try to make up in other ways. But for example, the Bangladesh government story is based on their preparing their their export, their garment sector at a time where they had specialized, their Bangladesh used to enjoy quotas in the international system, and they built up a garment sector based on that. We don't have that. We are nowhere near that. Similarly, Vietnam is actually kind of the back room, so to speak, of Chinese manufacturing, and that's something that's difficult for us to kind of mimic. Also, we live in a democracy, and we have we can't, our real wages are much higher than the real wages in these countries, and because of democratic reasons we can't squeeze out real wages the way some of these countries can. So having said all that, I think what we the realistic strategy for India would be two pronged. In the short and medium run, I think since we are focusing on, or we are not doing that badly with high tech sectors as well as services, we should try to provide as much incentive to those sectors as possible. So the PLI is one of those ways in which these incentives are being provided. Although I'm not sure, whether we'll be able to sustain this in the long run, because I'm not sure this would be WTO compatible in the long run, because WTO is as much about exports as it is about importables. I mean, tradable sector. So I'm not sure how long we'll be able to provide these incentives. But if we can do something for the next 3-4 years also, I think we'll be in a good position to then compete. Meanwhile, I would say that but we still need the low skilled sectors, because that's where employment generation is, right? And for that, we need to have a much more long term strategy, where already we are having some reforms in various markets, labor market, etc. But there are other supply side things that we need to take into account. For example, skill formation is not going as well as it should have. My view is that skill formation should be happening within industries themselves, where we subsidize industries to create skills within their production processes, rather than going to private colleges and places where they're not really picking up the skills that they need to. So I think we need to have this two-pronged approach. So if we do not increase our exports in the low-skill sector immediately, I won't be that worried. But I think we need to at least establish those as a vibrant domestic sector. So at least we should try and achieve 100% Atmanirbhar, self-sufficiency in garments. I mean, we should be able to produce our own garments, and then once we achieve that level of self-sufficiency and also competitiveness, because scale gives us competitiveness. Our domestic market is quite large; it can give us the scale enough to become competitive enough, and then we can try and make these sectors internationally competitive. So I think we need to have this two-pronged approach for exports.
Sure. So, Dr. Kar, as much as we gain from this interaction is that we need a lot of balance, and there doesn't seem
Right.
like a one right policy prescription how we stand in this year, pandemic year, and even after post-pandemic. And we should rather be looking out for a longer-term strategy now rather than 1 year or a 2 year strategy. And it's not fiscal versus monetary here in India. It's probably a more coordinated approach
Right.
that we would need. So thank you so much for joining us this afternoon. It's been very insightful and ahead of the budget. You've given us good references to look out for in this budget. So we'd be watching out for those. Thank you for joining us, Dr. Kar, today.
It was my pleasure. Thank you.